let's say the Fed decides not to cut, or we get to the third quarter earnings reports and those numbers have now been adjusted higher and higher, and somebody stubs their toe, you could see a big reaction to that. And so one of the things that I think makes sense for people for part of their portfolio is to lower the overall portfolio's PE before the market ultimately does it to them, which it will at some point. You know, the S&P is still trading at 22 to 24 times earnings, and the NASDAQ is over 35 times earnings. And those numbers, although they make us all feel happy as we're riding them up, eventually the market is sort of going to revert back to that mean, and those numbers are somewhere between 20 and 30% above the historical long-term averages. So I think it just makes sense maybe to be a little bit more barbelled as opposed to all in on one trade.
So does that imply then that if you're going to barbell it too, do you need to barbell it across asset classes? We've seen a lot of money continue to flow into bond ETFs. What are you noticing there?
Well, barbelling, for example, you could just as easily buy the equal weighted version of the S&P 500 next to the cap weighted, and that sort of would give you that barbell, right? You'd have more exposure to the bottom half of the S&P 500 and less exposure to the top half. And there's an equal weighted version of the Qs as well. In fixed income land, I think people are, mostly pretty satisfied just sort of sitting in short-term treasuries at 5%. There's been a lot of money going into those types of vehicles. I don't think on the fixed income side that we're doing sort of what we've been doing on the equity side, and that is we're underpricing risk. I mean, spreads are fairly narrow on a historic basis, and so you're not getting paid what you might normally get paid to go out the credit scale, maybe to high grade corporates or to high yield. And so I think if you can just collect 5% in the short run for that money that you maybe ultimately will deploy, makes a little bit of sense. We're seeing some flows into international and global. I think that's really just a rebalancing trade. The last 5 years have been dominated so much by large cap US that I think investors' portfolios have gotten out of balance a little bit. And so I think people are starting to push more money into global and international. And then we've seen quite a bit of money go into small cap for the same reason that, and that is that, because of this massive performance advantage of large cap US versus everything else, portfolios have gotten out of whack, and I think people are wise to sort of rebalance their portfolios that are more in line with what a longer term objective might dictate.
2024 is an election year. How concerned are you about that from a stability or volatility perspective for markets, and maybe how do you position yourself?
Well, you have two different agendas, right? You have one agenda that, is going to be more government and higher taxes theoretically. And you have another agenda that's sort of less regulatory oversight and lower taxes. And I think the market will be volatile between now and election day as, these candidates surge and fall in the polling. And so it'll be interesting to see. I don't think that now is the time to start really putting on those election type bets into a portfolio because there's so much time between now and November. But I think as we get closer to November and people start to really develop a clear view of who they believe will ultimately win the election, I think investors will start to position portfolios accordingly.
What's the one, before we let you go, what's like a risk that no one's talking about or not a lot of people are talking about that you see in the market right now?
Well, I said what I think is the biggest risk in the market, and that is that we're highly, highly concentrated. And this happens from time to time. It just never lasts. We don't know how long this will last, but it's not going to last for 5 years. It's been almost 2 years worth of this massive imbalance in terms of the weight in portfolios across the broad market indexes. And I think that's one risk that, look, we're human beings, right? And so we get euphoric, and when things are going well and we're making money on investments, we sort of ignore some of the potential pitfalls. And so I think the big risk is that we don't get as an aggressive Fed approach, and that we get into the third quarter and the fourth quarter as those tech names are sort of running uphill, right? Their earnings have been growing, but their forecasted earnings are supposed to be higher. And if somewhere along the way, and by the way, it's much more difficult for them to make those increased earnings numbers because of the massive size of these companies, that could potentially be a risk that people are ignoring right now.